Hey everybody, this is Jason Bronchetti, the Chief Investment Officer at Lincoln Financial Group. I hope you're having a wonderful summer and enjoying the sunshine. For me, summer means feeling energized with tons of outdoor fun with the family. Within the walls of investments here at Lincoln, we're just as energized to release the latest edition of the Market Intel Exchange, the MIE. Now, if you're not familiar with the MIE, it's Lincoln's flagship market chart book that we launched last year. It's full of great information on the economy, markets, and investment trends from the folks at Lincoln and our partners across the asset management industry. I encourage you to check it out. So as in prior quarters, I'd like to cover three key themes that are likely to remain on the minds of investors in the quarter ahead. Let's jump right in with the first topic: stubbornly high levels of inflation, and perhaps even more importantly, the Fed's response to try to bring those prices down. Now, inflation continues to remain persistently high. We've had year-over-year headline and core consumer prices rising 9.1% and 5.9% respectively in June, and they remain at 40-year highs. So let's talk about what's been driving the increase in prices. Well, largely, we've had the classic demand-pull inflation scenario of too many dollars chasing too few goods. Consumer demand for goods has surged, while at the same time, disruptions to the global supply chain have made it extremely challenging for suppliers to keep up since the COVID crisis. Adding to this is the war in Ukraine, which has contributed to a spike in commodity prices. Now, because commodities are such important inputs into the production and transportation of nearly everything we buy, this is feeding into higher prices that we've all been feeling, from gas at the pump to the grocery store. Now, the good news is we are seeing some positive signs that indicate we may start to see inflationary pressures ease in the back half of 2022. For example, with China continuing to reopen, supply chains have begun to normalize, allowing transportation costs for goods to come down. You can see this dynamic on the middle chart of this slide from the Market Intel Exchange, which shows the cost to ship a container from Shanghai to Los Angeles. While it's still well above pre-pandemic levels, it's fallen more than 38% from its peak, and the trend continues to show easing. Commodity prices are also beginning to show signs of coming off of their highs. The last chart on this slide shows the Bloomberg Commodity Index, which tracks more than 20 commodities futures, including energy, metals, and livestock. While prices are still meaningfully higher than they were 2 years ago, the index has fallen more than 14% from its recent peak set in early June. As for consumer demand, that's where the Fed comes in. So the Fed has made it abundantly clear that they're going to do, quote, whatever it takes to get inflation under control. Their primary tool to accomplish this is by increasing the Fed funds rate, which makes money more expensive to obtain and reduces aggregate demand. In March, they increased the Fed funds rate by 25 basis points, followed by 50 basis points in May and 75 basis points in June. Additional hikes are expected, with futures markets expecting the Fed funds rate to land in the range of 3.25 to 3.5% by the end of 2022. Now, this is a dynamic to keep an eye on. With economic growth moderating in the U.S., there's a growing concern that should the Fed get too aggressive in raising rates, it could tip us into a recession in the near term. Which leads us to our second key theme that's on the mind of investors at the moment: fears of a potential recession. While the R word is certainly getting a lot of media attention, it's important to take a closer look at the fundamentals. This is a great reference chart from our partners at ClearBridge Investments. It monitors several different recession risk indicators and flags the current status of each indicator as either expansionary, cautionary, or recessionary. While the indicators have been trending negatively lately as the economy is starting to cool, you can see that as of quarter end, the overall recession risk signal was still flashing green. Now, I wouldn't be surprised to see the signals reflect more caution in the near future. That being said, most of the asset managers we work with don't actually have a recession as their baseline forecast. And perhaps more importantly, it's critical to remember that recessions come in all shapes and sizes. If the U.S. were to enter a recession in the next 12 to 18 months, we would expect it to be relatively moderate and nothing compared to what was experienced during the global financial crisis. The fact is, the economy is in a much better position today than it was leading up to 2008. For starters, we're not in a serious housing bubble. Lending standards are still very strong compared to the global financial crisis. And while we could see some housing price weakness, we don't expect any material default spikes like we saw in 2008 and 2009. We're also less likely to experience the same financial contagion risk. This is in large part due to the regulatory framework and the stress testing that was put in place by financial institutions after the GFC. And lastly, consumer strength is a notable difference. Unemployment, wages, and household debt service ratios are considerably better today than they were back then. Consumers are not over-levered to the same extent as the period leading up to the global financial crisis. So again, despite the very real risk that the U.S. economy could slip into a recession, it's likely to be relatively mild in severity. All of that said, the lingering unknowns have led to risk assets beginning to price in the potential for an economic downturn, pushing the S&P 500 officially into bear market territory in mid-June. And therein lies our final key theme on the markets and on the minds of investors: bear markets. While the volatility that typically comes with bear markets can be uncomfortable for nearly every investor, it's important to remain focused on the long term. The fact is, there hasn't been a bear market yet that stocks haven't fully recovered from and gone on to set new highs, and this time isn't likely to be any different. Historically, bear markets have been some of the best times to invest, and this chart in the MIE can help put that into perspective. We took a look at forward 1, 3, and 5-year returns, not from the bottom of each bear market, but instead from the point where the drawdown had reached 20%, the typical threshold to be considered a bear market and roughly consistent with where we ended the second quarter. So as you can imagine, returns from that point were very strong. On average, the S&P 500 gained more than 17% 1 year later, and cumulative returns 3 and 5 years later were 36% and 61% respectively. While I'm certainly not going to call the bottom in the market, we feel this type of data can help every investor feel confident staying the course regardless of whether stocks have bottomed yet or not. So there you have it, 3 key themes on the minds of investors today. Persistently high inflation that's showing some signs that it may be rolling over. Concerns that slowing growth and a tightening Fed could push the U.S. economy into a recession. And last, bear markets and the opportunity that they have historically presented for long-term investors. Lincoln Financial is constantly monitoring what's happening in the markets, finding new ways to keep you informed, and most importantly, working to ensure we continue providing everyday Americans with the financial security and peace of mind.